to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. The OAM view is that we are past the point of peak inflation, peak central bank hawkishness, and peak bond yields. And on top of that, there's traditionally a seasonal relief rally at this time of the year in the last couple of months, particularly this year, because asset managers and institutions will want to show some kind of positive returns after what's been a fairly dismal year. So we have reduced cash levels in the portfolios. But of course, what happens next? Potentially there could be a bit of an earnings recession as the anxiety of the market turns from inflation towards recession. There's a lag period between monetary tightening and actual economic activity. And so it's possible that the markets might drop again in the first quarter of next year. And it could be a possibility that having bought shares that we've always wanted to buy for a long time, that we may do a bit of pruning or culling, getting rid of the weakest links in the portfolios ahead of that potential sell-off. So inflation is no longer such a problem. There'll be some celebration of that, but then some discounting of potential weaker earnings ahead before a recovery from what's likely to be quite a light, short-lived recession in the second half of next year. Anyway, so I'm going to talk about four different asset allocation views from MRB, ECR, Capital Economics, and Edison. I think our view is somewhere between MRB and Edison. They're all quite different, all very well argued. But before I start with that, just a little bit of central bank policy, Fed talk analysis from Cross-Border Capital, which is actually turning quite positive now. Last night, Jay Powell made a speech. The S&P 500 rocketed as a consequence of that. It is slightly surprising because he didn't really say anything new that had already been covered in the Fed minutes. The Fed minutes from last week say that, in inverted commas, a substantial majority of policymakers agreed it would likely soon be appropriate to slow the pace of interest rate hikes. The uncertain lags and magnitudes associated with the effects of monetary policy actions on economic activity and inflation were among the reasons cited. Also from ECB, there's an ECB policymaker, Mario Centeno, said the ECB should slow the pace of interest rate hikes from December and send a clear message that 75 basis point moves are not the norm, as inflation is likely to peak this quarter. And then Capital Economics, also on the Fed and inflation, they say the following: we wouldn't be surprised to see more of a consensus emerge among policymakers in favor of ending tightening cycles and eventually cutting policy rates. We expect cuts to start sooner and go further than is priced into markets. The ECB and also the UK, the Bank of England, they recently revised down their forecast for the Bank of England bank rate, now penciling in more cuts in 2024 than investors are. That's why, overall, we expect 10-year government bond yields in many developed markets to end 2023 lower than they are now. And that will be very supportive for the markets. If we turn now to global macro, we're going to start off with MRB. They're referring to a Goldilocks scenario for a while, no recession and inflation coming down. They do, however, believe the caveat to all of that is that inflation will reappear in the second half of next year and that bond yields will have a fourth upleg, damaging market sentiment and valuations. But at least for the time being, for the next few months, in fact, they say that equity markets have the potential to rebound for as long as government bond markets stay calm. The calming in developed market bond markets should continue for a few months. And then they look at credit spreads. So credit spreads, corporate credit spreads, the cost of corporate debt relative to the risk-free rate is a very good signal of distress in the corporate sector, in the business sector of world economies. And those credit spreads are actually behaving very well. With economic momentum relatively resilient, global credit spreads have recently managed to narrow after undergoing only a modest widening phase, despite the worst bond bear market and most rapid rate hiking cycle in decades. Well-behaved credit markets typically coincide with similar conditions in equity markets. We do not envision a global recession in 2023. And regardless of where inflation is headed over the coming years, we are in the sticky and much higher than 2% camp. The near-run trend will be down, and that's extremely bullish for the markets, at least over the next few months. So ECR tend to agree with the MRB view. They believe that inflation will gradually decline in the coming quarters, although we expect a hard landing of the economy. So they're different from MRB in that regard. They believe there's going to be a hard landing in the world economy next year, and that is in fact predicted by record inversion in the bond yield curve. That's to say, long bonds are substantially lower in yield terms than shorter dated bonds. So they're expecting a hard landing, and they also say that bond yields at the end of next year are going to be significantly, not just slightly, but significantly lower than where they are now. Interest rates on the 10-year US government bond will decline towards 1.5% in the coming quarters. The German 10-year government bond, the Bund, likely to decline towards 0.8% over the coming quarters. So in other words, very recessionary conditions. And then we've got capital economics. They predict a recession next year, but only a very shallow recession. We are forecasting recessions in the US and most countries in Europe next year. Admittedly, the recent hard activity data have been more resilient than we had anticipated. The recession, the most obvious reason, the full effects of the substantial monetary tightening over the past 12 months have yet to be felt. Our proprietary indicator now suggests there is a 90% probability that the US will be in recession in 6 months' time. It has never been this high without a recession following. With that said, however, it's important to stress that in the case of the US at least, we anticipate a relatively mild recession. Our forecast incorporates a fall in GDP of about 0.5 percentage points. The adverse hit to the terms of trade means that recessions in Europe will be deeper. We have penciled in a peak to trough fall in output of around 1.5 to 2 percentage points in the Eurozone and the UK, but even here, much smaller than the past two recessions. And what's more, a recovery is likely to commence over the second half of next year. And markets, equity markets, usually recover well ahead of a recession end, sometimes as much as 6, even 8 months. So possibly the markets are looking across the valley to the recovery from the expected recession already. Still sticking with capital economics, the speed and extent to which headline and core inflation in the US falls could be one of the surprise stories 2023. Moving on to Edison, I think this probably most closely reflects the OAM view. This is Edison. 2022 to date has been a tough year for investors, yet the painful post-COVID normalization trade may be nearing its climax. Long and short-term interest rates are now where they need to be to lower demand, leaving in prospect a period of disinflation. Furthermore, global equity valuations have fallen back to levels in line with long-term averages. Economic activity is expected to slow during the first half of next year in developed markets, but this will not come as a surprise to investors. By mid-2023, we expect the market mood to pivot towards an economic and earnings recovery in 2024. And the triggers, there are three triggers: further evidence of a peak in inflationary pressure, an anticipation of reduction in the intensity of hostilities in Ukraine as Russia's military objectives become increasingly unachievable, and China to ease some of its less business-friendly policies, including, of course, COVID-0. From current valuations, we expect 2023 will be a better year for global equities. Upward pressure on the dollar is also likely to moderate, benefiting non-US equities. Equity valuations, by far the most compelling reason for taking a more constructive view on equities for 2023, is that the valuation starting point has eased considerably over the past 12 months. A year ago, global equities were trading 2 standard deviations above their long-run average price-to-book level. Yeah, I'm actually going to end off now with a little look at emerging markets and China. The Chinese market has really rocketed over the last month. The MSCI China Index has had its strongest monthly gain in 23 years. It's still cheap, however, and may well be an opportunity. 2023, this is from Cross Border Capital. He's been bearish on China for a long time. He's now turning mildly positive. 2023 could prove substantially better for investors because the two key emerging market drivers, China and the US dollar, will likely be more supportive. Okay, well, that's it from my side, Gielie. How's it looking on the local markets?
Hi, Nick. Thank you very much for interesting and comprehensive macro overview. On the local side, I say it looks good. Just want to start off with Fitch, the ratings agency. On Friday, they just affirmed South Africa's BB minus rating with a stable outlook. So there's no change. There's not a downgrade. We are expecting downgrades, but I think that's a thing of the past at the moment. Fitch and S&P have us at 3 notches into junk status. Moody's is more friendly. They've got us 2 notches into junk status. Things are improving, and I think the general view is that the glass is not half empty, the glass is half full. Mr. Price, we own Mr. Price. They released data for the first half of 2023, and it's very positive. The earnings per share increased by 13.8% compared with the same period a year earlier. And then there was news from City Lots year to date, and I must just specify that this year to date is from July to the present. The year ended at the end of June. The occupancies are up to 56.5%. Now, that is very important. 50% is more or less a break-even point. Above that, they start making money. And if it goes over 60%, they start printing money. So some months they even exceeded the pre-COVID levels. In November, this past month, the occupancies are 60%, and the outlook for December is decidedly positive. And to add to this happy story, the room rates are also up. The room rates are up 10% compared to the prior year. And that is, the room rates are now at pre-COVID levels as well. And to summarize, just occupancies are up 100% and prices are up 10%. And that's very good for this company. And the net foreign selling of shares on the local market, it's went up to 73.8 billion. It's a bit up, but not nothing to worry about.